Let's go now to our friend Bimnet Abibi from Galaxy Trading, as always. How are you, my friend? Good to see you.
Doing well. Nice to see you, too. I know you're on vacation. So
Technically, I'm not here. I was in the office. I'm in the office because I'm on vacation in New York. And someone was like, oh, Alex, about that thing. I was like, no. I'm not here.
Yep.
Don't talk to me. But I will talk to you, my friend, because it's been exciting in markets.
Absolutely.
To point out, last week on our show, you said that gold was going higher. It has. We're through 2,000.
Yep.
You talked about the incredible technical setup for Bitcoin. It was higher on the monthly, the weekly, the daily chart looked good. We closed the quarter, 3 consecutive up months.
Correct. And an outside month to boot.
But I will say, just in the couple of days since then, Bitcoin holding in the 28K range. But a big geopolitical maneuver here. OPEC unexpectedly cutting production, and oil is ripping higher, which you pointed out was perhaps, if that were to happen, a risk for the market. What's happening now, I guess, with the oil thing, and how's that impacting stuff?
So, more specifically, we had OPEC and OPEC Plus agree to a surprise cut of about 1.5 million barrels per day.
Is that a lot?
That is decently chunky.
Okay.
The U.S., for context, consumes about 20 million barrels per day. So it's a lot. But remember, with commodities and with any market in general, it's a market set at the margin.
Yeah.
Right. So if you take 1.5 million barrels per day off, the market, right, it's definitely going to apply upward pressure to prices. In addition, some of the research we've read suggests that OPEC has more pricing power than ever, as in the marginal supply is more relevant than
from
it has
OPEC.
been from OPEC and OPEC Plus.
Yeah.
So, I think the market is correct in sort of pushing crude prices higher. And we went from about $75 a barrel for WTI crude to about $81 a barrel. That's been a pretty significant move. And through $81, $82 a barrel, there's a pretty strong resistance there that we've kind of been at for the past 3 to 4 months. So if we move through these levels, it kind of suggests you're going to be headed towards $90 or even $100 a barrel. Most of the street has moved up their year-end forecast for oil. We're in the camp of I think in the back half of this year, you're probably going to see oil prices closer to $100 a barrel. Partially a function of OPEC and OPEC Plus, being very strong-handed in terms of supply cuts, but it's also a function of dollar weakening. Today we've had a pretty, meaningful weakening of the dollar versus gold, but also versus other currencies. And I think that speaks to what we've had recently in terms of data. And what we've had in terms of the data is a meaningful continuation of the deterioration that we've seen.
Right.
So ISM manufacturing yesterday was incredibly weak. The prices paid component was really weak, which is inflation. The employment section was really weak. And then today we got job openings that dropped by a lot, durable goods that didn't look good. So even though oil has moved higher, and that is sort of has a very strong feedback loop into inflation, the hard data we've seen and the soft data we've seen from manufacturing and the real economy in the U.S. is suggesting quite the opposite, which is a slowdown in pressures.
I see.
And some of the other things I've seen, like credit card spending data for March is like down meaningfully month over month. So things of that nature point to like a cool down in the U.S. economy. But again, energy has such a strong feedback loop into like literally every good and service,
Right.
that it's a risk that people need to be aware of. And one of the ways, here at Galaxy, we think about it, you can look at like option structures on crude or energy markets and stuff. And so I definitely think that it should be in the average investor's, kind of toolkit, because that is a huge kind of like tail scenario for the market and for the disinflation story.
Yeah, it's interesting when you think about the cooling down should be good for the risk assets because it could mean the Fed's doing its job and they don't have to hike as much, and then we can finally take the foot off the gas on rates. But if energy is getting much more expensive, or if other commodities eventually do, right? The China reopening is still happening, right?
Yeah, no, absolutely.
Then that has a pretty inflationary impact long term, and it's awful because it's one of the things the Fed really can't impact very much, right? So they have to, if inflation overall stays high or goes higher, even while the economy is cooling, but the thing causing it is something the Fed barely can affect. We're still in that rock and a hard place scenario.
Oh, absolutely. I would hate to be a central banker right now. But again, like, they are. Yeah, there's no good outcome here.
Yeah.
And so I'm just kind of taking my cues from the markets, and what the markets are telling you is that, while there are upside risks to oil and stuff, like, it didn't go to 100 after the surprise cut.
True.
And rates have been moving lower, and the market is pricing in cuts.
I saw this.
And the dollar is weakening, and risk assets are rallying, right? And so it speaks to kind of, what we talked about last week on the podcast, which is the right tail of interest rate policy risk is kind of being removed from the market, right? Even if oil prices were to get, much higher, I think folks realize that, central bankers understand the limitations of monetary policy and aren't going to pursue that crazy 6-7% interest rate policy if, all of a sudden, bananas start to go through the moon.
And there are other things, right? I mean, if oil and gas go higher, I mean, I know we're really talking about oil and not gas, but if energy goes higher, right, then things like the U.S. like fracking complex maybe comes back online and can sort of.
It takes time.
I know it does. But
Yeah. No, you're right.
But there are other policy decisions that theoretically can be made in the U.S. to put it to sort of help out on the oil front. You can literally allow more drilling, for example. I know, again, this administration's not very keen on that, but if it got really bad, there are other tools other than interest rates to push back on that too. So very interesting. So the like you said, risk assets are rallying. I saw S&P's through 4,100, which I'm not an expert on this, but on TV, that's what they've been talking about as a key level on CNBC for literally weeks and weeks and weeks.
Yeah.
Is like what the sort of average, near-term bull has been targeting as the bullish level. And we're through that.
And NASDAQ's also, outperforming a lot. I mean, you're up almost, I think like 17-18% on the year.
Right.
But, one of the key things that, I think is worth pointing out is you're entering a period of very strong seasonality.
I was just about to say this. April alone as a specific month is a very bullish month.
Very bullish month. Like 80% hit rate of like being bullish. Like one of the highest months on average.
Which is wild.
And then if you look at like historical returns based on years where, S&P had a good start to Q1, like odds are you're going to have a great rest of the year.
There's only a couple years where it was up
actually less than it was then.
I was going to say there wasn't even. Are there even any years where it's down for the year? I saw there was some. There was like 1 year in the last 30 where it like was up a lot in Q1, but then barely eked out like
1 extra percent.
Yeah,
I
it was
think
like
that
plus,
was 1987 or something. Where it was up 7%, then it closed the year up 8 or so. Something along those lines. But long story short, there's been about 25 times when S&P's been up more than 7% in Q1, and basically 23 of those 25, you ended up having a great rest of the year.
Crazy.
So there's some good data to support.
I mean, that's the kind of stuff. It's sort of a historical guidance concept, but it's not prescriptive at all. Anything can happen. We're in crazy times.
No, absolutely.
But still, I mean, it's such a weird time here. Yeah.
And then the other thing to think about is just like, although there's feels like there's a lot of uncertainty in the world still.
Yeah.
Right. The actual uncertainty priced in by the markets has actually come off a lot.
Interesting.
And that's actually generally risk positive, right? So when we had that whole banking crisis, interest rate vol shot up, and twos are moving 25 basis points up and down like crazy. And now it's like a little bit more gradual. I mean, today's a little bit of an aberration given, the data print we've had. But the interest rate vol has come off a little bit. Liquidity has entered the market. The VIX is, on an 18 handle now. We spiked through 30 during that crisis. And generally speaking, like it's been a little bit calmer. Mm-hmm. And I think the Fed is more in a position where it's kind of wait and see. Right, they don't want to really cut rates throughout the balance. They just kind of want to wait and see. They'll go one more meeting most likely, and then just wait and see. So there's a lot less uncertainty in the market, I think.
And they got rates up high.
Pretty high enough.
Like they did a lot of hiking.
Reasonably high.
We're not at the beginning of the hiking cycle.
Correct.
Yeah.
And so one of the ways I think about my equation mentally, at least for the market, is like the more uncertainty there is, the lower the prices, generally speaking, and so right now we're adding less uncertainty into the market, and people are more comfortable.
We're adding more certainty.
Correct. And it's also just a function of like a $10 million position on a 20 vol is very different than a $10 million position on a 40 vol. right? And so naturally, as vol comes down, you have room to add to notionally to your position, because your risk unit is actually staying constant as your notional. And so as vol comes down, people can take more risk. And I think that's what you're kind of seeing, with things like S&P, NASDAQ, and a little bit of crypto.
What do you see? Yeah, I was going to say, how does this play into crypto? Let me set the stage here. I just saw that ETH BTC is back up a little bit. I mean, it's what, like 0.064-ish?
That's 5, I think,
0.065.
Yeah.
And it had gotten down to like 0.062-ish.
Yeah. I mean...
So ETH has been outperforming just the last few days. Bitcoin, I think year to date still outperforming, but ETH. But, is that part of this? It's sort of like, well, we're in a little bit of a, more risk on mentality right now. The street is feeling a little bit more comfortable, and ETH is seen as a little bit more risky. It certainly is higher vol than Bitcoin. Is that part of the story?
So I think it's the ETH BTC story, to me, is just positioning.
Yeah.
Right? People, got very bulled up on Bitcoin after, the banking crisis, fiat debasement, banking insecurity, etc.
Chancellor on the brink of second bailout for banks.
Correct.
That whole story.
And then, gold was ripping as well. And so, it had a really strong narrative, positive narrative. And, ETH with Shanghai upgrade coming up.
A little bit of uncertainty.
A little bit of uncertainty. And so what did you have? You have people positioned for that. And so ETH BTC moved a lot lower, right? As, Bitcoin had its huge leg higher. And then you're left in a situation where everybody's kind of like max long Bitcoin and max underweight ETH.
Mm-hmm.
And that's where we were like 2 days ago.
Yeah.
And then people are like, wait, ETH has been trying to break through like 1820 like 7 times now.
Yeah.
And like it broke through that level, today, and you had a subsequent rally in ETH BTC. I think the high has been like 1880
I think it's the highest, certainly highest year to date for ETH.
Since merge. Merge we got to like almost 1900 and change.
In September.
Yeah. And so I think what you've seen over the past like 2 days is just a positioning unwind where people got a little overextended on Bitcoin and a little underexposed to ETH. And you just had that unwind happening.
Yeah.
I think fundamentally, like, I still prefer being long Bitcoin, but there's no issue being long both right now.
Yep.
And I continue to think that one of the best ways to express it is upside options. I think people really underestimate kind of how violent moves to the upside can be, especially when you take out technical levels. If you think about it, we went from 20 to 28K in the span of 2 weeks, right? That's a huge move.
Yeah.
That's a 40% move.
Yeah.
Like that can happen in 2 weeks.
Yeah.
Right. And so, 1 month implied vol at like 60 doesn't really make that much sense in this kind of a market. And so I still think that the best way to play for crypto upside is probably in optionality. But being long also. It's long and strong.
Yeah. Well, it's a fascinating time. I'm excited to just keep following this.
Absolutely.
I mean, it's a much more interesting time in my mind now than it was, like, say, last summer. Remember we had that episode with you and Robert Bukoki and Christine Kim, I think maybe like June of 22, and we were sort of max bearish. I think
like that was 19K Bitcoin,
and
then we went to like 16.5.
I know, this is this famous, in my mind, famous episode where we asked everyone to say a positive thing, and you were just like straight up stumped, couldn't come up with anything. And yeah, that was an interesting time, but just the complexities swirling around in this market now are so interesting. The geopolitical stuff happening with China's reopening, but also China making all these moves on the world stage. Finland just formally entered NATO like this morning, which is literally an adjacent country, adds a dramatic amount of border with Russia to NATO. There's just a bunch of stuff happening. Even Mexico's foreign minister last week said that that their vision was aligned with the BRICS countries. They're interested in doing more with BRICS. I'm like, that's our southern neighbor, right? I mean, there's a whole get the debt ceiling.
Have you heard of NAFTA, guys?
We're going to talk with Tyler Williams. I know NAFTA. We're going to talk with Tyler Williams in a bit about the debt ceiling debate, which still has to happen in the U.S. Probably get solved.
That's noise.
I mean, there's a lot of moving pieces that makes
absolutely.
it an exciting time. So I'm looking forward to keep talking with you about it. But that's it for today. Bimnet Abibi from Galaxy Trading, our good friend. Thank you so much.
Pleasure. Thank you for having me.